Hi, everybody. It's Austin at Homeowners Financial, and I'm super duper excited about this new CalHFA program. It's a down payment assistance program. It's called the Dream for All Shared Appreciation Program. And I thought it'd be easiest to record a video and give some details. So, first and foremost, why am I excited about this? Well, I'm excited because here on coastal California, a lot of the down payment assistance programs don't necessarily work because in order to qualify for property here, you need to make a certain amount of income, and a lot of these programs have very tight income limitations. So this one actually is opening up to be more reasonable. Now, we serve people in California, Colorado, Arizona, working on Oregon as well. So we're all over the state. However, I am in the 805. And with this basis, our San Diego basis, our Ventura basis, our LA basis, San Luis Obispo, those are the main counties that we seem to serve here, that I want to make sure people know that there's a great opportunity. So we're going to do a lot of screen shares today, y'all. It's going to be absolutely amazing. So first and foremost, let's go ahead and kick it off and let's just go through some details in general about this program. So again, it is the CalHFA Shared Appreciation Loan Program. It's called Dream for All. Now we have to remember that this is grant money. This money can and will run out. We don't know how long it'll last. So this is a great opportunity to move on in the market ahead of time. So it is indeed a down payment assistance for first-time home buyers anywhere in California. You don't have to be in the 805. You can be in the 661. You can be in the 707. Y'all, you can be wherever as long as it's California. This will work. Now, again, it's for first-time home buyers. So how does it work? Well, it gives up to 20% of the purchase price in down payment. There are a lot of questions I get. Do I have to take the full 20? This is again new. So technically, no, you don't have to. However, I'm going to tell you you should take the 20% because in real life, that's how the program's going to work. And giving you variations on the program are going to be your specifics. So let's stick to the generalities. So it's going to give it up to 20% of the down payment in purchase price. No payments are made until there's these trigger events, right? Until you sell the property, you transfer the property, or you refinance a loan. And there's a caveat around the refinancing. And then CalHFA does share in the appreciation of the property. Now, look, if you never refinance or you refinance only once, which we'll get into in a second, this loan is forgivable. So if you were in that property for 30 years, it is technically forgiven. That's a really big deal, y'all. So how much can you purchase? Now, there's no down payment required if the sales price is 907, 750 or lower. Why is it that weird funky number? Well, there's a difference between standard conforming loans and high balance conforming loans. Standard conforming loans nationally are for $726,200. Anywhere in the country can get a conforming loan for that. Now, each county has its own subset. For example, in Santa Barbara County, we're at $805,000. In LA, y'all are like $1 million. Ventura is 948. So it's going to depend county by county. But if we're in that, then you do need to bring 5% down. That can be your money, it can be gift money. Now, notice I'm talking about the down payment. You do need to contribute to your closing costs. So it's not like you're getting a house for free. You will have skin in the game. There will need to be money paid at closing, but it's not necessarily the down payment. Now, who's eligible? You have to be a first-time home buyer. You have to be a first-time home buyer. This means you cannot have ownership in any property for at least 3 years or above. There's no co-signers, so you can't have your parents sign with you if you do not qualify, and all borrowers must occupy as their primary residence. Can't be a second home for one of you, but a primary for the other. Everyone has to live in the property. You all have to be first-time home buyers. You can have not any other ownership. And there's a tip. Expect that folks that are 18 years or older may need to be able to participate. Again, it's new, so I'm giving you all the generalities and worst case scenarios too. So there's a limit to how much you can make. This is your income. Yes, absolutely. In Ventura County, you can make no more than 228,000. In LA County, it's 180,000, and in Santa Barbara County, it's 198,000. Those are very interesting numbers. But what is this little 80% AMI, Austin? What is that? That is the average median income for the area. Now, there's a qualifier that you qualify for a lot more down payment assistance programs if you're at 80% of the AMI, 80% of this valuation, you're considered in a separate bucket as a home buyer, and there's more programs for you. In this situation, if you are at that AMI level or lower and you're using this down payment assistance program, instead of getting 20% of the appreciation, they only get 15. So they'll still give you your 20% down, but they're only going to ask for 15% of the appreciation, so the amount you borrowed plus the appreciation back. What kind of mortgage can you get? This is a Dream for All CalHFA conventional first mortgage. It's not FHA, it's not VA. Everybody gets the same interest rate no matter what your credit score is. It is straight direct with a CalHFA, and as an approved CalHFA lender, we have access to those websites. Hint, hint. So do you. You can Google it. It's public information. As of the date of recording that for this, which is March 21st, the current rate is 6.5. It was 6.125. Now it's at 6.5. So it can change, and it's whatever those rates are. You can't buy them down. It very simply is what it is. Is there a difference for 80% AMAs? So that's what I was hinting at a little bit closer, right? So the amount of appreciation CalHFA gets when you sell or refinance really depends on your income level. So again, when we get the program and we're above that, if we're at or above the 80% AMI, then they're going to get the full 20%. But if we're at or below, it's going to be the 15%. For example, let's say that you buy a $500,000 property. Well, 20% that is $100,000. Okay. Now let's say the property is worth 600,000. So you gained $100,000 in equity. If you were at this 80% AMI factor, they're only going to get 15,000, 15% of the 100 in gain. But if you're above, it's going to be 20%, 20,000. So they get their original 100 and then that portion of the gain on top of it. So when do you have to pay that back again? I said, if you sell the home or otherwise transfer title, right? So if you own the property and you want to gift it to your brother, that's a transfer of title. Now, we're not talking about folks that get married. We're a community property state. That's not a thing. If you pay off the first mortgage, now look, if you just pay it off and refinance, then you maybe do that money. You are allowed one refinance as long as it meets the new CalHFA requirements. So that means that it's got to be a CalHFA first approved mortgage, and that rate will change. We don't know what it's going to be at that time, but we are expecting rates to go down. So this is a great opportunity so that you don't feel that you're stuck in that 6.5% long term. It is hailing outside my window. Small distraction. You are also required to pay it back if you default. So if you start to be foreclosed on that property, that money is indeed due. It's not free. So what does this all mean in real life? Well, we're going to go play with some numbers. I'm going to stop this original share. I've got a spreadsheet. Y'all know me, I have a spreadsheet for everything. And I'm going to go ahead and share the screen that calculates through some numbers. So I built this out today with the CalHFA interest rate. Y'all can see this changing as it goes through. Now, this is the $98,000 level of income for Santa Barbara County. So let's say you've got credit card payments of $150 a month. Maybe you've got a $500 car payment. Maybe you have some student loan payments at $250. We know you can't own any other properties, so I'm not going to put anything in that field. Now, the total income for the household again is $16,500. And if we were buying at 500,000, we're getting that 20% from CalHFA at that 6.5 interest rate. Assuming this is a condo with HOA and insurance, your payments would be about $3,500 a month. Your back end ratio, which is the total of all of your debts from your credit report, as well as your housing in relation to the amount that you owe, is 26.96%. So you should qualify. This is probably going to need to be around a 45 or 50%. It is run through the system. We get verifications. There are different factors on your credit history that may make it go up to 50% debt to income versus 45. But for the intents of tonight, I want to make sure that you guys have this as a basis. So let's look at this differently. Let's say we took it to the top, that 907,500 number, right? So you see how this is right there at that conforming loan limit. Look, you'd still be within scope. So you could technically make this much money, $198,000 a year, and qualify. Well, let's take it to Ventura. That would equal 228,000 divided by 12. In Ventura, now we know that there is what's called high balance, right? Now, high balance in Ventura is 948,750, 948,750.8 divide means that that's about a whoop, 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 1,185,937 sales price. Ooh, it's all the funky numbers, right? Now, in this world, you wouldn't necessarily qualify, but you're probably not buying a 1.1 condo. You're probably buying that as a house. Let's say insurance is around 150 a month. We're all back in. So that's how it works in real life. Now, of course, your parameters are your parameters, and we want to make sure that you've got all the right information. So reach out. Let's do some scenarios together. Now, all right, now that we know what it means in real life, what else do we got? What else do you need to know? Being pre-approved does not hold your down payment funds. First steps first is we have a conversation. What do you do? Is this a great candidate for you? Do you understand the pros and cons of this program? Great. Now we're going to pre-approve you. You're shopping for a house. That does not mean you're guaranteed the down payment assistance funds. The money can run out. Once you're in contract, then we can start to reserve the money for you. Just like you lock a loan when you have a contract with a property and an end date of when this money needs to be used by, that's how it's going to work for this program. Yes, you can close in as little as 21 days. I don't believe that you can go faster, but you should be able to close in about 21 days. 30 days, no problem. 45, great, right? You do have to use the full 20% down. Now, we are pitching back and forth of can they do less, but they want you to do this 20% down. Another question someone asked me today is like, well, can I layer it? And yes, you can. That first mortgage needs to be no less than 70% versus 80% loan to value. That's a lot of weird loan stuff, y'all. The basis is there's a lot of opportunity. So how do you know if this is the right program for you? I don't know. Let's have a conversation. We're all here to help, right? We got to see where you qualify and what your options are. That's really the next steps. So, again, this is the CalHFA Dream for All program. It is absolutely fantastic, in my opinion. It is a great way to enter the market if you feel that your savings is not able to catch up with the increases in purchase price. Do be prepared for some intensive closing costs. If it's high balance, CalHFA has a 1.4 additional percent charge of your loan amount. So it's not free money. There is a hook. They will share in that appreciation of the property, but it's a great, great way to get things going. So do let me know if I can help you or anyone else. Make it a great day, y'all. It's Austin Homeowners Financial. Bye.